Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris Mcintire. Mcintire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome again to the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for that common sense approach to planning for our financial and retirement futures that we all need. He is president and founder of Mcintire Retirement Services. Chris Mcintire back again with us. And Chris, it's that time of year. We all look forward to it. Time to prepare and file those taxes.
Yeah, we'll see how coronavirus affected tax returns. And, I know our CPAs, they just booked up solid with appointments, as many of them are doing virtual appointments. So, and the way the mail is slow with 1099 calls and everything, I would imagine this is probably going to go a lot like the election with, mail-in, not ballots, but mail-in returns are going to be coming in later and later, unfortunately. Just a sign of the times, I guess, Peter.
Yeah, well, I think that taxes on a regular basis, Chris, are something somewhat of a pain, a thorn in our side. None of us look forward to it. However, I think we all need to really rethink and revisit how we address and think about taxes. We tend to be retroactive and in hindsight, we file the documents, we prepare the documents, but preparing taxes is not planning for taxes into the future. And it's minutia in the language there, but there is a huge difference in the meaning and the end result.
Oh, absolutely. And, a good example of this would be is we have a number of CPAs in the northwestern Ohio area that we refer our clients to. And some of them are very good at being proactive in looking at tax planning. So we send certain clients that have tax planning needs that we can work hand in hand with the CPA on. And then we have other clients that just need a basic return, pretty simple Social Security, pension income coming in, not a lot of after-tax dollars spinning off dividends and interest, and not necessarily some of these larger, maybe seven-figure IRAs, if you will, where hey, we really you got a legacy problem here. You've done very well. Your children or your beneficiaries have done very well. Let's work a little extra harder here to make sure that the Internal Revenue Service isn't any bigger of a beneficiary than they need to be.
Certainly. And congratulations if that's you. I've heard that taxes are a good problem to have, but somehow, Chris, the word problem still stands out there to me. It's still a problem and an issue. And I don't think anybody likes to deal with that problem, but we all need to be proactive with it to get the best result possible to minimize that tax implication. And so, ladies and gentlemen, if you've got questions about how to plan, how to set up, how to structure the plan and your finances for your future to control that tax liability wherever possible, pick up the phone and give Chris Mcintire a call, 800-868-1194. That's 800-868-1194, 800-868-1194. And today we'll talk about how tax planning can make a big difference in your financial outcome and really change the decisions that we are making now. Chris, I don't think most people are aware that the current tax laws, the rates and brackets that we are in today, actually have a sunset provision. It was already slated that they would be changing and taxes would be going up in the very near future.
Yeah, that's very common in the legislative world, is when they pass laws, they may only be for 10 years or 20 years, and then they sunset or go back to where they were before. So, these taxes were not made permanent, or the tax cuts under the Trump administration were not made permanent. And, we need to plan or consider, I think most people would agree that the current administration here has a different tax plan than the previous administration. That's probably a fair statement here without naming names and having to fight off a bunch of emails that'll come in over that. But, that's certainly been stated there that, they want to let those taxes sunset and go back to where their rates previously had been, which, you can make an argument either way of that, I guess. And,
well, Chris, do you think that means that the change that was already, again, previously slated, because the sunset provision, do you think that they could be more proactive and substantial or quicker than was previously planned for?
It certainly could be. I would think a lot of that's going to be predicated on maybe the election that we're going to have in 2 years when the House of Representative comes up again, which is basically right around the corner. In all reality, from from a planning standpoint, they're not going to change tomorrow.
Yeah, it seems like we never leave political season these days.
You're exactly right. And the control of that House Budget Committee is obviously where the purse strings are, and that's where all of that comes out of. So it's a very powerful committee that has been under control of the Democratic Party here for a number of years. And but the divide in the House is very narrow right now. What 8 or 9 votes, I think, is all it is. So this next election will be a very important one for that very provision right there. And and again, right now, that floated a $2 trillion stimulus package here. Again, that's adding on to the debt that at some point will have to get paid. And all these crises are very expensive. And we have a very how do I want to say this? We have a very good way of spending our way out of problems, but never paying for them.
Yeah, indeed. Well, Chris, I have heard that spending today equals taxes in the future. So I guess one of the most important questions as we plan for our tax future and as we save retirement dollars and make decisions about where to place them, will taxes be lower in retirement? This is sort of the axiom and the paradigm that we have been saving under this pretense, this belief over the last 30 years. Are you seeing that hold true? And do we want to continue with that way of thought?
Yeah, to preface that, let's take a look back in the past. And in 1986, if you had income of $68,000, you were in a 38% tax bracket. I think it was 68,400 to be technical. You were in a 38% income tax bracket. Today, that would be 12. So, right now we have a very
Today you
low...
would be in the 12%. You would have been in the 38. Today you would be in the 12% tax. That's a major drop.
It is a major drop. So, I think the paradigm shift needs to happen is like, look, do we need to do what we did in 1986 is what we're doing in 2021 just because, that mantra hasn't changed or somebody hasn't tweeted that we need to change our way of thinking, if you will. And, you and I have been on the show for how many years talking about Roth IRAs that are tax-free and Roth IRA conversions and taking advantage of capital gains and capital losses to offset one of them, each other, to benefit yourself and also your children. There's a legacy part of all of this that comes into play as well. We had the Secure Act in at the end of 2019, essentially, that said, okay, all IRA accounts that go to non-spouse type beneficiaries have to be paid out within a 10-year time frame. That's a huge paradigm shift. That was step one, I guess we could probably call that, Peter.
Chris, I heard a phrase when it comes to the tax code, when it comes to retirement, the tax code is written in pencil. And it seems like the laws on that can change at any point in time. So that's hindsight. Looking back, yes, tax rates and brackets have dropped substantially. Looking forward, do we want to continue believing that they will continue on that path?
Well, no, we don't want to just, have the same mindset that, okay, what was good 10 years ago was going to be good 20 years from now. And, and being proactive, understanding the tax bracket that you're in, understanding the impact of required minimum distributions coming out of IRAs later in life. Most people realize, probably their long-term aspect in retirement is 3 to 5 years, not 15 and 20 years, because if you've retired at 65, 72 seems like forever, and 82 and 92, and most people think, well, I'm going to spend more money now, at age 65 than I am at age 85. Well, how do you know that? What if you're in a nursing home at $6,000 a month? That's spending a lot of money, obviously on something none of us want to deal with, but it's certainly one of the biggest threats that the people listening to the show are going to have to face.
And taxes are handled differently in retirement. I mean, when we're in our working career, Chris, it's kind of out of sight, out of mind, done automatically. For most of us, we work a job, we show up, and we get paid to do so. But before we actually receive the money, Uncle Sam has already taken his piece. In retirement, we've got our accounts there, and we're creating our own paycheck and income, and we've got to account for that tax liability in that bill. We either got to write a check for that bill, or we have to manually decide how much to deduct from each and every withdrawal we make. I think it's a little bit more of a painful process and realization. Do you find that a lot of your clients are kind of surprised and shocked by that?
Absolutely, Peter. And many of them have, no idea how much tax they need to have taken out of withdrawals that they make. And part of that is because, it was done for them forever for 30 years. So they have this mindset that somebody else takes care of that problem. All of a sudden you come into retirement, you're like opening your own business, if you will. Peter, you and I have to write our quarterly taxes and set money aside. So we're used to budgeting for that. Many folks that are listening to the show today have never had to do that. So, they go into retirement, and then, a perfect example, client retires at age 62, takes his Social Security benefit, takes some money out of his IRA accounts to supplement his income. And the problem was he was trying to stay on Obamacare. So he had to keep his income very low, or he was going to get kicked off the exchanges and have to go out to the retail market and pay, $15,000 to $20,000 a year for his health insurance. So that was a tax trap. And if his income went up, above 68,000, his health insurance got crazy expensive. So, he had to live poorly for 3 years until he got on Medicare, so that he just didn't write huge checks to the medical mutual, for example.
Now, Chris, I mean, that is something that I believe could have been planned and prepared for if we had the advanced knowledge, correct? And then that may be the difference, a great example, at least, of the difference between filing and tax preparation versus tax planning with a forward-looking proactive approach.
Correct. Had he had the advantage of working with us a couple of years ahead of time, we would have kicked some money into a Roth IRA just for those purposes, that he could have pulled out income tax free and lived a little bit larger life versus living on bits and pieces, if you will. He truly had to live off of bits and pieces, or was going to spend an incredible amount of money just on health insurance.
Well, tax deferral is tax payments in retirement. When we retire, those deferred tax dollars turn to tax payments that we owe. And Chris, that's really why there's three different buckets of money, and why we need to explore the utilization of those three different, we'll call them categories, for how to classify our dollars when we save them.
Yeah, Peter, I love this analogy here. And, the three bucket analogy is an easy visualization for the folks listening or watching us today on the podcast. We have a taxable bucket. That's where our income is coming from right now. That's taxable income. We have a tax deferred bucket. For those of you that are retired, that might be where your IRAs and your 401ks are. That money is tax deferred until you pull it out. Then it kind of flows into the taxable bucket. And then we have a tax-free bucket. That's where your Roth IRAs are. That's where your cash value life insurance is. We like to employ that strategy as well for folks also. Again, Pete, I don't care what kind of strategy it is, what the investment is called. They could call it, Wonder Bread for all I care. Is it a good tax-free strategy? Is it, is a Roth IRA going to be made up of a portfolio of mutual funds? Is a life insurance policy going to be funded to take advantage of the tax codes that allow you to borrow against your policy, income tax-free, keep it invested, that sort of thing? I don't care what they call it. Does the strategy work? Is there precedence, and has there been good arguments made that these benefits work? I have two cash value life insurance policies on myself, one very small Roth IRA, because my Roth IRA distributions still show up on a tax return. Okay. My distributions from my life insurance policy do not.
So bottom line, Chris, I mean, there are some tools that work to address these issues. They're out there and available. We just got to maybe dig a little to find them.
Yeah, and and don't believe every little sound bite that you hear. Not to bash any of the other professional talking heads out here, but the difference between some of them that say buy term and invest, the difference is they don't ever sit across the table from a client.
Well, again, if you've got questions, if you've got concerns, if you'd like to identify some of these strategies that can give you a more tax efficient outcome into your future throughout retirement, pick up the phone, give Chris Mcintire a call, 800-868-1194. That's 800-868-1194, 800-868-1194. And Chris, further reason why we may want to utilize some of these tools, dig deeper, do that work, discover them, understand them, and then potentially utilize them in our planning, is that it's not just taxation as we think about it. There's truly like a double and triple whammy compounding effect when you look at how tax deferral affects not only withdrawals, but then can affect Social Security and can affect our Medicare premiums.
Absolutely. And that's kind of the hidden traps in some of these things, if you want to call them that, especially like a large IRA withdrawal. Interest rates are low. People are buying houses down in Florida like crazy. So an example is somebody says, all right, hey, we're going to pull a one-time large distribution out of our IRA. We've never spent money before. We found a condominium we want to have. We don't want to finance it. We're going to write a check for $150,000 or $250,000. The way real estate's going in Florida, obviously. And all of a sudden, next year they get a bill where their Medicare premiums went from $145 to $345. That's a hidden tax trap there. Obviously, the Social Security side is really an unfair issue. The Social Security taxation side, meaning the more income you have that's taxable in retirement, the more of your Social Security that can be taxed. And the unfair part of that is they started taxing Social Security in 1983, and then they taxed a little bit more of it in 1993 and never adjusted those income levels for inflation. So they're still treating $32,000 in 1983 like 32, in just using $32,000 in 2021 for forgive my stutter in there, 2021. And obviously we know 32,000 in 2021 doesn't buy what 32,000 did in 1983.
No, that's a substantial difference. The 32,000 was a pretty healthy income back in the early 1980s, whereas today that same standard of living probably costs 70, 80,000, if not more. So again, these are things that people are not educated about, are not made aware of. Let's say it's not highly advertised or talked about that as your withdrawals from those 401ks go up, it's going to cause your Social Security to also become taxable when it could have been avoided if you had done proactive planning, if we were made aware of that, that those withdrawals from tax deferred accounts can cause your Medicare premiums to go up substantially if you hit current or certain income thresholds. And these are things, Chris, that are going to impact our bottom line. The question of how long can I make my money last? Taxes are a big issue when it comes to this. And because of this, Chris, people with larger balances, if they ignore this issue, make a more costly mistake, if I can say it that way, is that our tax system is not just proportional to where if somebody's got $20,000 versus $20 million, that it's going to be a proportional tax. The higher the income level, the higher the wealth level, the more costly the mistake is going to be in ignoring this issue now.
No question, Peter. Perfect example is, let's look at all the COVID relief bills. The 1.9 trillion that, had been discussed here at in this early first quarter part of 2021, was $53,000 per person to send you a $1,400 check. Okay. Where do you think they're going to come up with the money to pay all of that back, right? Because, all they've done is issued bonds at very low interest rates. And now we are starting to see the impact that inflation is having. The price of goods is going up faster and faster and faster now. That's a stealth tax as well. So, not understanding and taking a proactive stance here, guys, you're probably going to end up giving more money to the Internal Revenue Service than you are legally obligated to do. We love Roth IRA conversions. We love using the cash value side of life insurance, the very efficient vehicles. Some of this stuff's very technical. If you're listening on a radio show, obviously it's hard to visualize some of these things, but if you don't do anything, just imagine where the income taxes are going to be the day you pass away, knowing that if they were in a Roth IRA, that income tax rate is 0, and instead of some undetermined rate to pay down a 20-some trillion dollar deficit that we have. Where do you think the money's going to come from? Those who have it or those that don't?
Well, again, if you would like to plan in advance for this, if you'd like to be proactive, if you'd like to get that game plan for retirement in your hands, don't hesitate. Pick up the phone right now or click around this video to take Chris Mcintire up on the offer for that complimentary review and to get your game plan for retirement. Concise, consolidated, easy to understand language, a snapshot of where you are, a discussion of goals, writing those down so that you can work those goals and make them your reality into the future through the recommendations, the simple, easy to follow instructions, step-by-step timeline of executable action items that you need to take in order to achieve your goals. Pick up the phone and give a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, I like the statement. I'm going to circle back to it. When it comes to retirement, the tax code is written in pencil, and Uncle Sam, the IRS, is your business partner in those retirement accounts, but they're the one with the eraser and that can write the rules.
They absolutely are. And, they set all the rules. They have the only playbook there. We have to play by their rules. They don't come back and ask you, okay, hey, what do you think's a fair rate to pay? You haven't paid any taxes on this money that you've been accumulating for 30 years. Is it 15% or is it 40%? And I think everybody listening today would agree that, boy, taxes are very low. We have a very tax-friendly environment right now, folks. And, if within the next couple of years, there could certainly be some shifts there. If you were going to be a betting person, I think most folks would agree that, hey, we got a pretty good chance that taxes are going to go up. We're going to lose some loopholes, to pay down this deficit from the coronavirus pandemic. And, why wouldn't you want to start taking advantage of moving some of those assets into different positions by bits and pieces? We're not talking about cashing out a $500,000 IRA here and paying the taxes on it tomorrow. Developing a strategy where over the course of time, we sometimes, Peter, we'll call it an accelerated RMD. So if I've got somebody that's 65 years old with $1 million in an IRA account that they don't need right now, right? If they were 72, they got to pull out about $36,000 a year of that, okay? Whether they need it or not. It's like, look, why don't we start taking that, if it makes sense, why don't we start taking out up to that 36,000 right now and moving that into a Roth IRA, okay? Because you cannot convert your required minimum distributions into a Roth IRA. You'd have to take money over and above it. So for most of you, between 59 and a half and 72 is when you have your biggest tax planning strategies.
So really, this is a window of opportunity within the retirement red zone, Chris.
It most definitely is, buddy. Yep. And we can't emphasize that enough. And we probably talk about this 6 to 12 times a year anyway for everybody. So please, guys, pick up the telephone here. Now's a great time to get working on some of these tax strategies. Keep more of what you've earned. That makes sense.
Absolutely. Chris Mcintire can help you identify those strategies. Pick up the phone, give a call, 800-868-1194, 800-868-1194. Chris, can we just do a quick overview of a few of those specific strategies? What if we are still saving our way toward retirement, making ongoing contributions? What do we need to be thinking about in that situation?
Yep. If you're making your current contributions into your traditional IRA accounts, that may make sense given the situation you're in right now. If you make, a significant amount of money, that may make the most sense for right now. But you also may have the ability to put some money into a Roth IRA. Even if you're working and you're putting your money into your 401k, you can still consider a Roth IRA if you have some additional discretionary dollars. Now, Peter, I'm going to shift here to talk about the life insurance side of things with the cash value piece. It's a non-traditional way of using life insurance because typically when you're buying life insurance, you're wanting to put the least amount of money in and get the largest death benefit. With cash value life insurance, we want to put the most amount of money in and get the least amount of death benefit to make the policy very efficient from a tax flow standpoint. So if a life insurance company can give you an annuity payment for as long as you're expected to live, okay, they can certainly do the same thing out of a life insurance policy, except the tax rate could be zero for you.
And then accelerating those RMDs, that's another opportunity, and maybe looking at that one a little bit different than if we are still working and saving toward retirement, but that would be something potentially once we're already retired. But Chris, if we've already got a large tax deferred balance built up, that's definitely something on either side of that. We need to maybe look at proactively making conversions, correct?
We absolutely need to be looking at making conversions. Anyone can convert. Not everyone can make a contribution. Very important. Anybody can convert at any time. It's still, you're going from an IRA to a Roth IRA, so you do not need to be 59 and a half to do that. That is a taxable event. So if you just slid $10,000 out of an IRA into a Roth, you have to pay tax on that 10,000, which brings up other questions. Okay, where do I get the money to pay that tax bill on, and so on?
Doubling up on contributions. Chris, we've got a kind of a window of opportunity within a window of opportunity here between January 1st and the tax filing deadline. We can actually double up in a couple different ways. If we've got a married spouse, a couple, there's a chance for doubling up. But if we've also can sort of cross tax years and double up as well.
Yeah, absolutely. And a personal example here is, this was one of the rare years for 2020 that I actually contributed to an IRA versus usually doing a Roth IRA and life insurance and everything there, just because where the income was this year. For us, it made sense for me to actually put some money into an IRA, and we do that, and my wife as well. So if you're over the age of 50, you can do $7,000 a piece. So sometimes that makes the most sense. We're not here talking bad about IRAs versus Roth IRAs. It's a whole tax planning technique and having a strategy in place.
So, I mean, theoretically, Chris, where we ask the IRS, hey, what's my limit for a new contribution? They may say, well, if you're over 50, $7,000. But we actually have the opportunity to potentially get up to $28,000 in if we're married, going for last year and this year for ourselves and our spouse. That's 4 times that annual limit.
Correct. 20 and 21, $7,000 a piece, 7 times 4, 28,000 that you can shift into, and do some tax planning for 2021 at the same time you're doing tax planning for 2020. And I'll throw this out there for folks. Most of you have your IRAs invested in the stock market. If the stock market takes a significant decline, that's a good time to shift some of those assets. Okay, maybe you're invested in an S&P 500 mutual fund, and if it falls 15, 20%, slide some of that over into your Roth IRA, and then, and let it grow from there. So there's opportunities in everything.
Chris, real quick, as we're wrapping up, you had one other opportunity because of the current tax laws. A lot of people lost the opportunity to deduct charitable contributions. But if we are taking those RMDs, you can actually still get a qualified charitable distribution, and that might not be taxable to you or the charity or organization that you're donating to.
Yeah, that's a great way of, being charitable, is having your required minimum distribution paid directly to a charity. It's not taxable to you, and the charity gets it income tax free as well. What a win-win situation.
Well, taxes are a pain. They're the thorn in all of our side. Paying taxes means you made money. So we have heard that it's a good problem to have, but problems are still problems. And not planning ahead for taxes, not understanding fully how taxes work in retirement, that can make that problem, that pain, much more significant. So as always, Chris Mcintire makes one big offer, and that is to help you identify strategies to be more efficient with your money, to identify opportunities to keep more of it, to make it work harder for you. And that's through the planning process. Get that game plan for retirement in your hands. At McIntire Retirement Services, they help savers and investors better determine their outcome by making their goals their reality through the planning process. Specifically, if you'd like to learn how to retire, when you can retire, how much you'll have to pay in taxes, how to better control those elements that are beyond our individual control, and keep more of your money, give a call or click the link around the video, 800-868-1194, 800-868-1194, and request the time to speak with Chris Mcintire and get your game plan for retirement put together and in your hands. 800-868-1194. That's 800-868-1194. Chris, we always appreciate your time and the resource that you are to so many savers and investors across Northwestern Ohio.
It's my pleasure. We hope we can help you folks keep a little bit more of your hard-earned dollars here listening to the show. Thank you, and everybody be safe.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris Mcintire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.